final session of our seminars in economics 2021. We hope you found them all interesting and very, very important, especially for our Cape 2 students or young economists who will be sitting exams next month. Our final presentation is on national income accounting, and we have I almost want to say our returning champion, Mrs. Karen Anderson Reed, and she, of course, is from the Immaculate Conception High School. So all my Immaculate people in the house, on my MS Teams, or watching on YouTube, there's a little hoot hoot for you. All right, without any further ado, Mrs. Anderson Reed.
Okay, so good afternoon, everyone. I am Karen Anderson Reed. I am a senior economist here at the Bank of Jamaica, and I will be presenting this afternoon National Income Accounting. All right, so in terms of an overview, this afternoon we're going to be looking at what is national income accounting. We're going to be talking about GDP and what exactly is that. We're also going to be looking at the circular flow of income. How do we measure or derive GDP? How to interpret or use GDP? We're going to be looking at real versus nominal GDP, and finally, we will close with limitations in the use of GDP. So, what is national income accounting? It is basically the science of how we measure an economy's overall economic performance, focusing on the overall level of production of goods and services. It is the bookkeeping system that a national government uses to measure the country's economic activity in a given period of time. National income accounting records the level of activity in accounts such as revenues earned by domestic corporations, wages paid to foreign and domestic workers, and the amount spent on sales and income taxes by corporations and individuals residing in the country. It is also the framework that summarizes and categorizes productive activity over a specific period of time. Usually that period of time is a year. So why would we want to measure economic performance? We want to measure economic performance so that we can track the long-run growth of the economy and facilitate cross-country comparisons across time. So we want to know, specifically for Jamaica, if we are growing, how fast are we growing, or if we are not growing, why are we not growing? And we want to be able to compare that growth with other countries. We want to also measure economic performance to assess the health of the economy so that we can compare output per person across countries. Output per person is referred to as GDP per capita, and we want to be able to compare using that metric. We want to also measure economic performance so that we are able to assess the effectiveness of macroeconomic policies. So, for example, whatever the policy is, we have forecasts and we want to track the performance of the economy to see if they are meeting those targets or those forecasts. So how do we do this? How are we able to, measure economic activity? What is the system that surrounds the way or the method in which we measure economic activity? So the Jamaican system of national accounts is prepared on the 1993 United Nations System of National Accounts, which is also called the 1993 SNA. It has a base year, and that base year is 2007. We have estimates. The estimates of national accounts provide a comprehensive measurement of economic activity in the country. And when we compare over corresponding periods, these estimates are valuable indicators of how the economy has performed in relation to the stated policy objective. So the single most widely used indicator of economic performance is GDP. Now, what is GDP? We will be discussing this further, but just to say that GDP is the market value of final goods and services produced within a country during a specific period of time, usually a year. Right? So this slide takes us right into that. It's the value of all final goods and services produced within the borders of an economy during a particular time interval, usually a year. So, of course, there are some phrases that I want to bring to your attention in this definition. Final goods and services. So that means that GDP takes account of final goods and services, finished products, and it does not include used items such as houses and cars, and also it does not include transactions in which money is transferred without any good or service in return. So for example, when the government does transfer payments like PATH, that is not included in GDP. Those PATH and other social benefits. So we're looking at another phrase this time that really, which is produced within the borders of an economy. So that means that to measure GDP for Jamaica, for example, we're only going to be looking at production that takes place in Jamaica without regard to whether the production is done by Jamaicans or foreign factors of production. For example, if Chinese labor should come to Jamaica to work, then when we are measuring GDP, the output from their work would be measured in GDP because it takes place within the borders of Jamaica. So we are also going to look at another very important definition in national accounting, and this is gross national product. Now, this is the value of final goods and services that Jamaica's citizens produce during a particular time interval, regardless of their location. So what this means is that no matter where Jamaicans are, their production is measured in gross national product. So, for example, when we send our farm workers to Canada and they work, their production is measured in gross national product, but it would not be measured in gross domestic product because that is production done within Jamaica. So now we're turning to the circular flow of income. And in terms of the circular flow of income, we're going to be looking at firms and households as economic agents. Now, of course, the assumption is that the economy is only composed of households and firms, and that households own the factors of production and they consume goods and services, while firms hire the factors of production to produce goods and services. So this is our circular flow. And if we follow the black arrows at the top, firms produce goods and services, that is moving from right to left. And at the bottom, households provide the factors of production to firms. That's from left to right at the bottom, that black arrow. Of course, what are the factors of production? They are land, labor, capital, and entrepreneurial ability. Now, if we look at the red arrows moving at the top from left to right, we have consumer expenditure. That is households buying goods and services from firms and spending with them. If we look at the bottom, the red arrow moving from right to left, we have some of the payments to the factors of production. Wages for labor, rent for land, interest for capital, and profits for entrepreneurial ability. So in terms of measuring national income, there are three approaches to calculating national income. These are the income approach, which is where we add up all the income received by the factors of production generated in the economy during a specific period of time, and this includes wages from employment and self-employment, profits to firms, interest to lenders of capital, and rent to owners of land. In terms of another approach which may be used in measuring national income, we have the production or output approach, and this is the combined value of new and final output produced in all sectors of the economy. For example, manufacturing, financial services, transport, and agriculture. In terms of the final approach to measuring national income, the expenditure approach, that adds up all the spending in the economy by households and firms on final goods and services. No matter which approach you choose to measure national income, whether you choose the income approach, the output approach, or the expenditure approach, all three approaches should give you the same result. They should be equal. So now we're going to look at the characteristics of GDP. So GDP is a monetary measure. So we use market value. That means we are valuing the output at current prices. Also, to avoid double counting, intermediate goods are not counted, and we will get some more into this as we will be going through some examples of what are considered as intermediate goods. So only final goods are counted in GDP. It also excludes non-production non-production transactions, such as some of those I mentioned before, such as transfer payment or the sale of used goods. So GDP excludes intermediate goods, and I thought it important that we go through an example of this so that, I can show you where double counting could take place, and so that we can be aware of how to exclude it. So on my slide, I have a simple example. What we're doing, we're making ketchup. We're making ketchup and selling it to the consumer. And we start with the first process where the farmer produces tomatoes and sells them for $120 to a processing firm. The firm processes the tomatoes and sells the paste to Grace Kennedy for $200. Grace uses the tomato paste to manufacture the ketchup, which is sold to the supermarket for $250. The retailer then sells the ketchup to you for $350. What we are trying to determine here is what would be the value that would be included in GDP. So if we just simply went about and took all the values that are reported on this slide, we would end up with $120, which is what the farmer gets for selling the tomatoes to the processing firm. We would also include probably the $200 for the paste and the $250 for which it is sold to the supermarket and the $350. We would get a total of $920. But this is not correct because we have included the cost of intermediate goods, and so this result would not be right. What we need to do is take one of two approaches, which is one, either we can take the final price, which is the $350. Second step, which is the processing of tomatoes into tomato paste. The value of growing tomatoes would be the cost of the input, which is $120, and the price of the output, what the tomato paste was sold to Grace for, is $200. So of course, the value added there would be the difference between the $200 and the $120, which would give us $80. Grace buys the paste for $200 and then sells it to the supermarket for $250. So of course there, the value added being the difference between the $200 and the $250 is $50. The retailer which sells you the ketchup bought it for $250, sold it to you for $350. So of course the value added there is $100. Now if we should sum the value added at each stage, we would get the final price, which is $350. For example, we would have imports, which are those goods and services which we buy from abroad, and we would also have exports, which are those goods and services which we sell abroad. In terms of the banking sector, of course, we know that households, when they save this money with banks, firms borrow this money and they invest it. They invest it in things like capital equipment, and investment, of course, is an injection. Right? The government taxes both households and firms and spends. clothing. We have like payment for services, which institution, that's a service. In terms of investment, we have spending by firms on new factories, office buildings, machinery, and for example, if firms add to their inventories, plus the spending by households on new houses. Note that when households buy new houses, it is not included in consumption, it is included in investment. Of course, there are different categories of investment. So we have business fixed investment, which consists of spending on construction, durable equipment, and as well as the breeding of stock. For example, if you have a farmer that has cattle or orchards. We have also residential investment, which is expenditure by households and firms on new houses and new apartment buildings. We have also inventory investment, which is the amount by which firms change their inventories during a given period. So for example, if a firm produces products and they are not sold, then they can build up those products in their inventories. It would be counted. If, for example, demand is high, firms can pull stock from their inventories and sell, and that would reduce the level of their inventories. All right, so we're going to broadly look now at how is consumption related to income. Right? And I know you're seeing a lot of equations. So my friends who are mathematically inclined are smiling. But there are some of us who do not particularly love this part, so I will go slowly to ensure that you get it. So at the top, we have our aggregate demand equation, which is our GDP is equal to our consumption spending, our plus gross investment, plus government purchases of goods and services, plus exports, minus imports. So consumption can be further defined as income. So when you work, you get an income, and of course you have to pay tax on your income. In Jamaica, if you are at the taxable threshold, if you have reached a taxable threshold, you would pay tax on it. So of course, income minus taxes is what we refer to as disposable income. But of course, when you get your income after paying taxes on it, you can either decide to consume all of it or to just consume a portion of it and save some of it. So that is what our first equation is saying. It is saying that what we consume in any period is our income minus the taxes that we pay on that income minus what we choose to save from that income. Now, our second equation is another way of defining consumption. And basically, in mathematical terms, what that equation is basically saying is that consumption increases with income. Because we have a straight line and it's upward sloping, so if you should take your ruler and just draw lines to meet both axes, you will see that for a higher level of income, there is a higher level of consumption. But let's look closely at this equation, the second equation. A is what we call autonomous consumption. What is autonomous consumption? You must consume, so even if you don't have an income, there will be still some consumption. So that is the autonomous level of consumption. It does not depend on your income. Now, if we turn our attention to the graph in the left, we will see A, which is where the line meets the y-axis. And of course, at that point, income is 0, but the level of consumption is A. So remember that. The autonomous level of consumption, when income is 0, does not depend on income. The next term, we have another term, which is B times disposable income. Now, B is really B tells us the fraction of our income that we tend to consume. In economic terms, it is called the marginal propensity to consume. Of course, this B is between 0 and 1, because when we work our income, we can either choose to consume a very small portion, close to 0, or we can choose to consume almost all of it, close to 1. So continuing, don't lose focus. We're still trying to figure out how consumption is related to income. So of course, we'll be using some of those equations that we've seen before, and we'll just be doing some simple substitution. For example, if you recall, on the previous slide, we had C is equal to Y minus S minus T, which is basically saying that C is equal to income minus savings minus taxes. So we are also going to be using that to get, particularly in addressing this last part of this equation. Of course, the A is still autonomous consumption. The B is our marginal propensity to consume, which we have said is between 0 and 1. And then we have 1 minus T times Y. This is the portion that you might be wondering how we got it. So of course, we are consuming out of our disposable income. And of course, the taxes that we pay on that income is a fraction of the income. So we have another equation here that says that T is equal to small t times Y. This is simple. Think of it this way. If your income is, for example, $1,000, and the tax rate is, for example, 25%, then the taxes would be the 25% of your income, right? And of course, the taxes, that would work out to a simple $250, right? So what we have done here is to have our income subtract the tax portion, which is the TY. So if we should expand this bracket, we would actually get Y minus YT, which is the same as this TY down here in the tax equation. And the Y, of course, would be our income. So we are continuing with these equations. Of course, we know that our disposable income is our income minus taxes. We have discussed that. We also know that from our disposable income, which is the equation 3, we can either choose to consume, which is C, or save, which is S. So we're going to be combining 2 and 3. So we consume plus saving. So what we consume plus what we save, of course, this is our disposable income, which is DY. And then on the right-hand side, we have Y minus T, which is also disposable income, because this is our income minus taxes. Now, we put those two together in a simple equation, and we have C is equal to income minus taxes minus what we choose to save. So, this is another way of writing the relationship between consumption and income. And you have seen this equation before. All the same, even though the notation might seem different. All this is saying is that consumption is equal to CO, which is our autonomous consumption, plus B, which is our marginal propensity to consume, and Y minus T is our disposable income. And that, of course, is referred to as our consumption function. Below, we have seen this equation already, which just says that the taxes are a fraction of income. And of course, we know that that fraction is between 0 and 1. So next, we take a break to ensure that you understand what we have been discussing. There are some questions here that relate to GDP. So of course, there are 6 questions. It says for each of the following, say whether they are normally measured in GDP and explain why. Since we are using the chat, I will just ask you to say yes or no. So I'm going to ask you to look at these statements very carefully and determine whether these would be included in GDP or not. So A says the sale of a 2014 Mercedes-Benz car in January 2015. Would that be included in GDP? A simple yes or no. So in the chat, I actually want you to give all 6 answers at once. Right? That is what it's going to take to get a prize. All 6 answers should be correct. Because I've actually taken off the part where you would have to explain why it's yes or no. So B, the services of a manicurist in the current year, is that in GDP? Yes or no? The profits of a foreign-owned corporation operating in the domestic economy, is that a part of GDP? Then we have farm work in Canada by Jamaicans. Is that a part of GDP? A new mansion built from the profits of illegal drug exports. And I know, I'm telling you here that it is illegal, right? So would that be included in GDP? And the last one, the cooking of meals for home consumption, Is that included in GDP? So please put your answers in the chat. Remember to put all 6 answers. A, yes or no. B, yes or no. C, the same. D, E, and F. You must include all 6 answers. All right, so of course, we have another exercise. This one uses those equations that we have just gone through with the consumption function. It has, for example, it's using all of aggregate demand because we have the consumption function, we have a value for investment, we have a value for output, which is Y, we have a value for imports, we have a value for exports, and we even have our tax function, where it is saying that taxes is a quarter of income, right? So for this one, this is calculations using all those equations that we went through. You need to calculate what would be consumption expenditure, what would be government expenditure, and whether there is a deficit or a surplus, and by how much. So again, these answers, you need to, again, put them in the chat. So if you didn't participate in exercise 1, it would be easy to recognize because those should be just yes or no. But this one will be numbers. So, of course, put your answers in the chat to win a prize. So, continuing with our national income accounting, we said that GDP is all the production that takes place in Jamaica. And if we want to move from GDP, if we start with GDP and we want to calculate GNP, which is gross national product, which is the value of goods and services that Jamaica's citizens produce regardless of their location. So, of course, GDP is the production that takes place in Jamaica. GNP is the production that takes place by Jamaicans, no matter where they are. So, to move from GDP to GNP, we would need to add what is called factor income. So, of course, what is factor income? It's the income from, well, we would add the income from Jamaican-owned factors of production that are located outside Jamaica. So that would be our farm, the income from our farm workers in Canada. And then we would also need to subtract the income earned by foreign-owned factors of production that are located in Jamaica. So if you remember the previous example that I had used, I'll use that same example. This would be the income earned by Chinese nationals, for example, to give an example. Right? So to move from GDP to GNP, we would add the income earned by Jamaican-owned factors of production that are outside of Jamaica, such as our farm workers in Canada. And we would subtract the income earned by foreign-owned factors of production that are located inside Jamaica, such as the Chinese nationals that are working here. So, moving from GNP, which is production by all Jamaicans, no matter where they are located, if we take GNP and subtract depreciation, which is also referred to as capital consumption allowance, we would get net national product. Now, net national product is derived by taking GNP and subtracting depreciation of the existing capital stock over the course of time. So, of course, what is depreciation? It's a measure that we set aside to maintain the productive capacity of the economy. More, if you think of an equipment, the more we use it, the more it is becoming worn, and at some point it will have to be replaced. So depreciation really gives us the value of that equipment as it is being used up over its useful life. Right? Of course, depreciation would lower national income, right? So, moving from net national product, which is all the production owned by Jamaicans, excluding replacement costs, and the replacement cost here is depreciation. If we subtract indirect taxes and add subsidies, of course, we would get national income. So, what is national income? It is the income earned by the factors of production, and it consists of wages and benefits, proprietors' income, rental income, corporate profits, and net interest. So if we just recap a little bit, if we start with GDP, how can we measure national income? Remember, we moved from GDP to GNP, and what we did, we basically added the income from Jamaican owned factors of production located outside of Jamaica and subtracted the income earned by foreign owned factors of production located inside Jamaica. So that's the movement, or that is the measurement from GDP to GNP, which is gross national product, which is all the production of Jamaicans, no matter where they are located. So when we got to GNP now, we subtracted depreciation, and we ended up with net national product. And to move from net national product to national income, we need to subtract indirect taxes and add subsidies. So that was a small recap for you. So moving on, we're going to talk about different measures of GDP. Real GDP versus nominal GDP. So what is nominal GDP? Nominal GDP is GDP evaluated at current market prices and includes all of the changes that takes place in prices over the period during the current year, and the changes are usually due to inflation or deflation. So inflation is an increase in the price level, deflation is a reduction in the price level. So in Jamaica, more often than not, we are accustomed to inflation, even though there are some times when there has been deflation. So nominal GDP is just the value of production at the current price, right? So in order to abstract from the changes in the overall price level, so if we want to measure GDP and not have price impacting the value, then usually we look at real GDP. And real GDP, we use the market prices at some base year. It will become clearer in the following example. So in this example, very simple example, we have sugar and yams. Let's say in 2007, this was the production of Jamaica, 100 tons of sugar and 50 tons of yam. To highlight the difference between real GDP and nominal GDP, if we were to look at nominal GDP, of course, we would be using the price level for the current year. So the price of sugar in 2007, as we have it here on the chart, is assumed to be $60 per ton. And the price of a ton of yam is assumed to be $40. So of course, doing simple calculations, the value of 100 tons of sugar would be $6,000. And the value of 50 tons of yams would be $2,000. So nominal GDP in 2007 would be $8,000. To show you the impact that the price level has on nominal GDP, we have kept the quantities the same. So we still have 100 tons of sugar and 50 tons of yam. That is still our production. Now, in 2011, sugar is now valued at $100 per ton. So, of course, 100 tons of sugar at $100 per ton is $10,000. And 50 tons of yam at $60 per ton is $3,000. So, nominal GDP is $13,000 in 2011. But has our production changed? And the answer to that is no. Production has not changed. It's just the valuation, the prices of the items that have changed. And so this is why real GDP is important, because if we should only look at nominal GDP, it would appear that production has changed, but it really has not. We are still producing 100 tons of sugar and 50 tons of yam. So I love examples. So on the next slide, we have another example. And we're using simple items, those which you are accustomed to. So this is an economy with only sodas and patties. So, of course, in year 2000, we're assuming that the price of a soda is $120. The price of a patty is $150. The number of sodas that we produce is 10, and the number of patties produced is 30. So even from now, I will clue you in as to where we're going with this. We're going to use this two-commodity economy to calculate what nominal GDP would be in 2000. We also have 2010, and of course, when we look at 2010, the price of a soda is $145. Price of a patty is now $170. We're now producing 105 sodas and 250 patties. So, of course, we want to go through how we would calculate nominal GDP for each year. So, the next slide helps us. So, of course, for 2000, if you look to the left, I have done some calculations to assist you. So pay attention to the column that says 2000 nominal GDP. Production was 10 sodas at $120. So the total there is $1,200. 30 patties at $150, the total there is $4,500. So nominal GDP for 2000 would be $5,700. So of course, for the time being, let us ignore the second line, which says real GDP, and let us just focus on nominal. So moving to this column, 2010, nominal GDP, production, 105 sodas at $145, $15,225. 250 patties at $170, $42,500. So nominal GDP for 2010 would have been $57,725. Now, if we assume that 2000 is a base year, remember I mentioned that the system of accounts, the system of national accounts, which Jamaica uses, the base year is 2007. So if we assume that the base year is 2000, real GDP in 2000 will be the same as nominal GDP. And that is a feature of all systems of accounts. In the base year, nominal GDP and real GDP are the same in the base year. So if we should use 2000 as a base year for the production that was done in 2010, of course, what we would be doing is using the prices from 2000 and applying those to the quantities of 2010. So in 2010, the production is still 105 sodas and 250 patties. But in terms of the price, we would be taking the prices from 2000 because 2000 we are assuming is our base year. So the price of a soda in 2000 is $120. So 105 sodas at $120 is $12,600. 250 patties at the price in the base year, which was 2000 at $150, is $37,500. So we'll see that the value of 2010 production in terms of prices in the base year, which is 2000, is only $50,100. And of course, that is intuitive because the price is increased. The price of a soda in 2010 was higher than the price of the soda in 2000, and so was the price of the patty higher. So, of course, if we were to use the base year, because inflation would have taken place, there would have been a change in the prices, of course, it would be less using 2000 as a base year. So this slide basically is just going to give us some equations or, to show us exactly what we did a while ago. So in calculating nominal GDP in the simple economy, it's basically the prices in the current year, which is P current, times output in the current year. Why current? But we realize that if we were to calculate real GDP for any year other than the base year, it would be output in the current year times prices in the base year. Of course, there is the GDP, the calculation of the GDP deflator, which we did not do, but that is simply giving the GDP deflator is basically, it tells you basically the price level. And so, like the CPI, while the CPI includes all the prices from the consumer basket, the GDP deflator includes all goods and services. So the CPI only has consumer goods and services, but the GDP deflator has all goods and services. So we can calculate the GDP deflator by taking nominal GDP, dividing it by real GDP, and multiplying by 100. So this is our calculation of the GDP deflator, which is a price level, price index. As I mentioned before, the GDP deflator is always 100 in the base year. And there is a simple reason for that. Nominal GDP and real GDP are the same in the base year. So nominal GDP divided by real GDP would give us 1. Times 100, that would be 100. Finally, we are going to look at GDP as a measure of welfare. So, GDP is a way to measure economic activity. But like other measurements, it's not perfect. Still the best we have, but not perfect. So, it is not a perfect measure of economic well-being. And we can think of some reasons why this is so. It ignores resource depletion. For example, when we think of bauxite in Jamaica, or bauxite stores are being used up every year, we sell bauxite, the resource is being depleted. Is that measured in GDP? No, it is not. When we think of, for example, our environment and all the negative impacts that have occurred, the deterioration of the environment, that is also not measured in GDP. When we think of income inequality, GDP on the whole might be looking good, it might be high in terms of the classification of our country as a middle income country, but is income distributed equally? Is everyone able to enjoy the same average level of welfare? And the answer to that would be no. We have people who have access to more resources and people who have access to less resources just based on their income. So of course, GDP does not show income inequality. There are also some good things that are not measured in GDP. For example, the work that you do as a volunteer, the meals that your mother so lovingly cook for you, and your clothes and other things that are taken care of, those items are not measured in GDP. Of course, there are some other things that clearly do not contribute to our welfare. So for example, when we have a hurricane, after the hurricane, there's usually a lot of spending, which increases GDP, but has our welfare changed? The answer to that question is no. So GDP also does not accurately capture the underground economy. So for example, that question that we had about illegal drugs, that answer should have been no. So GDP does not capture unreported income from legal sources, and it does not capture income from illegal sources. And with that, we have come to the end of our presentation, and I thank you for listening. I hope you have learned a lot. Please feel free to send your questions in the chat. I hope you have been winning the prizes based on the exercises that you were given, and have a good afternoon. Thank you.
I'm going to just thank you, and so you can go on and I'll monitor the chat after to see if anybody has no, but
Not even the easy one, yes or no?
not even one. Are you giving the answer them in the second in other slide?
If they been there, did I answer?
Of course, they're not. They don't want to write it.
Just write one no, two no, three no.
They're afraid. Thank you, everyone. We have now come to the end of our revision seminars in economics 2021. We do hope you found this enjoyable and informative, and that the information that you receive here will put you in good stead for those upcoming exams. We know exam starts next month, and we want all our CAPE 2 students, our young economists, to do very well. I will monitor the chat for a little while after, just to see if anyone has answered any of the questions, so you can claim your prize. So, and remember, you can subscribe to our Bank of Jamaica's YouTube channel. So if you're on our YouTube, just click subscribe, and you can and anyway, you can always see these videos again and again, because we know you might want to refresh yourself. So with that said, I'd like to thank you all for being here, and you do have a wonderful evening and a wonderful weekend, and again, best of luck in your examinations. Thank you.